The Nasdaq continues to fall as investors rotate out of tech stocks. Value stocks are in and growth stocks are out for 2020. All this news comes out after Pfizer announced a vaccine that is more than 90% effective. I'm sure you've heard this news already because it sent the market shooting up over the past trading day. We saw record highs in various sectors of the market, such as travel, which absolutely exploded. And this potential vaccine can really help the economy reopen and go back to normal. And all of the stay-at-home stocks, the stocks that are kind of predicated on people staying home, no vaccine, pandemic growing, got absolutely hammered yesterday. And in this video today, we're going to discuss which tech stocks that have seen a huge decline are actually at a good buying point right now, and which stocks you should avoid moving forward. We're also going to discuss some sharp increase in stocks from the travel sector and whether or not we believe this is actually a good sign and if the travel sector is still undervalued compared to where the price of these shares will be once we get officially reopened and back to normal. If you're new here, I am the Gen Z investor, and every single day we talk about the stock market, go over different stocks you can buy and sell within your portfolio. And in this video, we're focusing, of course, on the news that the tech sector is declining. It's time to sell out of tech and go into the value plays. We're going to discuss what I think on this topic, and I'm going to go over the tech stocks that I think are actually at a great buying point during this most recent dip in the market, and overall, which tech stocks I will not touch with a 10-foot pole. The most common saying in the stock market is to buy low and sell high. So when growth stocks are getting hammered, this may lead to a great buying opportunity, especially when the market is rotating out of tech. Now would be the time to take a look at the tech sector, look at which companies have actually seen a decline, and take a look at the companies that you believe are going to succeed over a longer term span. Which companies have operations that will continue to grow regardless on the pandemic? What companies will continue to grow revenue and earnings whether or not we're in a stay-at-home economy? Those are the stocks that you should take a look at during this dip. The stocks you want to avoid are the stocks that are heavily reliant on the pandemic. The stocks that are shot up 100%, 200% over the past 12 months that are really only rallying because of the use of their services within the pandemic and within a stay-at-home economy. Those are the companies that may be time to lock in some nice profits because they are on a massive run-up and transition over to the value or into some growth stocks that have been on a decline that actually have potential to sustain operations over a longer term span. So I'm going to focus on 4 different tech companies that have fundamentals that are going to continue to grow and are not going anywhere anytime soon. And these are companies that of course are tech-based but operate within different industries such as online e-commerce, financial tech, artificial intelligence. These are examples of industries that are still going to grow even after the pandemic. Once we can get the pandemic under control, we can save everyone's lives. These specific industries and many more are going to continue to grow without the need of some stay-at-home stocks that we have been using rapidly over the past few months. So we're going to discuss these companies and the fundamentals and why I believe they're going to continue to grow, and the fact that they're all on a decline right now because of this great news of a vaccine may lead to some nice opportunities to get in on a good dip. The travel sector, though, before we jump into the tech stocks, saw a rapid increase yesterday. We saw companies like Carnival Cruise Line in one single day jump up over 39%. We saw a company like Wynn Resorts, which has absolutely been decimated over the past year, jump up around 27.5%. We also saw all the airlines see a significant bump up, and American Airlines stock, for example, jumped up 15% in one single day. So the travel sector, the hospitality sector, saw a huge boost yesterday. This side of this vaccine was the first, light at the end of the tunnel they've seen because of this pandemic, and is actually giving investors hopefully some little confidence that one day these companies will get revenue back up, continue to drive up sales once again, and once travel begins to open up, they expect the stocks to flourish. For me personally, it's still too early. This is just one single news report. It hasn't even finished the trials just yet that will get those results by the end of November, and it still hasn't been mass produced, it still hasn't been mass distributed, and a lot of things could still go wrong for me. So the fact that these companies have seen this massive run-up scares me more than it excites me. For example, with Carnival, the day after they increased by 39%, shares today are down over 11%, and we haven't even hit the midday part in trading. So overall, I think these companies went up way too fast, way too soon, without a clear end of the tunnel situation, without a clear vaccine fully distributed, without cases going away. I still think this is way too early to transition into the travel sector. Now we're going to go over the 4 tech stocks that I believe may be in a buying opportunity right now because of this most recent dip in the market. These are companies that have strong operational growth and are expected to continue to expand post-pandemic with very high growth rates. And the first one is Amazon. So this company, as of late, has taken a beating. On the 5-day chart from their most recent high, shares are down over 9.5%. So close to a 10% decline in the largest e-commerce platform in the world at a point in time where retailers are still shut down. We're entering into the holiday season when spending goes up. All of these signs kind of point towards a very strong fourth quarter for Amazon. And the fact that this company is trending downwards very hard and is down close to 10% in a matter of a few days may make this one of the best buying opportunities within the tech sector right now. Amazon is expected to grow at over 30% per year over the next 5 years. And to get this company on a 10% discount might be a nice opportunity to jump in and buy. And if we take a look at their income statement, this is a company with very strong fundamentals. So nothing really has changed about this company moving forward. The convenience of using Amazon to order goods directly to your household, get them within 24 or 48 hours is mind-blowing. They absolutely dominate in the convenience setting, and overall this company, I believe, isn't going anywhere anytime soon, even after the pandemic is over. They've seen insane total revenue growth, a consistent year-over-year beat in total revenue, 100 billion 5 years ago, up to over 347 billion over the past 12 months. And if we take a look, they're profitable. These are the companies I already mentioned that may be at a buy right now. All 4 of the companies I'm going to talk about in the tech sector all see growing revenue and are all posting positive earnings. A lot of tech stocks right now that are seeing massive run-ups are losing money every year. They're actually spending more cash to grow the business and operate than they're bringing in. And those are the tech stocks that I think are going to get hit extremely hard, because even if the pandemic is over and they kind of lose their upward momentum, there's not going to be really anything that stops them because they aren't posting very strong earnings. So Amazon brings in a ton of net income as well, and that will only grow as the company expands, as the pandemic gets over. The net income and bottom line will increase over time. The second stock that I think has a nice buying opportunity is PayPal. They've been expanding rapidly. Of course, they're a financial tech company kind of within that e-commerce realm because they, of course, facilitate digital payments. But they're expanding, of course, into Bitcoin, which I think is a big market for the company because they are actually the largest financial institution in the world right now within the US to actually allow people to buy, hold, and use Bitcoins within transactions. So I think it's kind of a nice little expanding tool for them. They also own Venmo, which has seen rapid growth, a 61% year-over-year growth, and this is almost approaching around a $1 billion in revenue for this little acquisition they made a few years ago within PayPal. So they've seen nice potential growth from PayPal. The fact that they facilitate a ton of payments online really gives me that potential for the stock moving forward, and this company has been absolutely hammered, down over 11.4% on the 5-day chart. So another stock that has been growing in revenue year over year, consistent, beautiful year-over-year total revenue growth that is posting nice high earnings, over $3 billion of net income over the past year, and net income has been growing each and every year as well. So these are the tech companies that I believe are sustainable over the long term. They're making money. They're growing their earnings each and every year. They're expanding their customer bases. Their acquisitions and their smaller parts of their businesses are growing, like we see Venmo within PayPal. They're doing everything right, and the stocks are still getting hammered. PayPal down 11% is the second stock that might be a nice opportunity right now. The third stock we're going to discuss today is Etsy, another e-commerce platform where on the 5-day chart, shares are down over 20%. A 20% decline in this e-commerce platform that has posted a beautiful 2020. Their Q3 results were great, and they gave strong guidance throughout 2021. They're entering into the fourth quarter, which of course, similar to Amazon, is where a boost towards holiday spending comes. This is a company that kind of specializes in, more unique products and services. And these are the type of goods that people buy as gifts within the holiday season. So I think Q4 is extremely a strong place for Etsy. And to get them at a 20% decline over a 5-day span is absolutely insane. This company, once again, has been growing revenue rapidly. They posted $1.3 billion in total revenue, which on the grand scheme of things for an e-commerce company may not seem like a lot. But for a young tech stock with $1.3 billion of total revenue, they brought in over $230 million of net income. They are profitable. They are cash positive. This company continues to grow very nicely. And overall, within 2020, the fourth quarter of 2020, a year where we've seen a demolishment of physical in-store retail, I don't think that's going to happen anytime soon. The Pfizer vaccine will not be fully distributed until late 2021 into 2022. I think retail is still going to be shut down over the holiday season, and I think a company like Etsy will explode. I think Q4 results are going to be astronomically high, and I think we're going to see a massive write-up from this e-commerce platform to end out 2020. So getting it in at a massive decline as of late right now is a nice opportunity. And the fourth one is ticker TTWO, Take-Two Interactive Software. Another company down 12.97%. A 13% decline in a matter of 3 trading days for this massive company. They operate within the video game sector. Video games have been exploding. Of course, the PayPal, the e-commerce, those companies have been growing through the entire market. Every generation of people right now are using those to facilitate payments. But video games are expanding within the younger generations like crazy. Now with the stay-home economy, people have fallen in love with video games. The streaming, the esports demand is going to turn into a multi-billion-dollar business growing forward. And Take-Two is one of the leaders within that industry. They've seen a beautiful run-up as of late, and the company only trades at a PE of 37. Compared to some of their competitors within the industry, that is very good. And if we take a look, another company like I've mentioned, growing revenue year over year, exactly like we want to see, with profitable earnings. I'm an income guy. I like companies who actually make money. All my companies in my portfolio personally pay out a dividend. They all make net income and reward shareholders with a dividend. But if you want to get into some growth stocks that don't pay out dividends, you want to get into the ones that have strong fundamentals and actually bring in net income. Like that's what I want to stress to people is companies who aren't making money, of course they can sustain operations. They can get debt, they can sell shares to bring in cash. Like there's so many ways they can continue to grow. But until the companies can really turn profitable, they won't sustain themselves for a long period of time. And take a look at TTWO. Beautiful earnings growth each and every year. Over $400 million of net income last year on around $3.3 billion of total revenue. That's what I like to see. I like to see young tech companies actually bring in profitability over the last 12 months and over the past few years that is growing each and every year. And that's how we're going to kind of wrap up this video. We talked about 4 different tech companies that I believe will continue to grow, might be nice additions during this most recent dip in the market, and I also went over some companies I would never touch. Companies with massive high PE ratios, companies with low revenue but high market caps, companies that are losing money each and every year. Those are the stocks that it may be worth to transition out of right now before they may see some further decline moving forward.